So welcome everybody to our second session of business tax revision. I hope everybody is well, that you've all had a good week since I saw you last time. I'll talk a little bit about our plan for this evening. So we want to just continue looking through this mock assessment, and in our first session we looked at tasks 1 and 2 primarily, but we had a little bit of time and we wanted to make sure that we maximised as much of the exam as we could. So we went on and looked at task 4 as well. So in this evening's session, my primary focus is task 3 and task 5. And depending how we go for time, we may also have a look at task 6. That really is just time dependent. Because the session is recorded, if we are, say, part way through task 6 and you decide that you don't have time to stay any longer, then you can just pick up with the recorded version for anything that you miss. So that's our plan for this evening. Let me then, just for the purposes of anybody that might be joining us for the very first time, just direct you to a little overview of what to expect in this assessment. This is taken from the examiner's report, and if you haven't already reviewed the examiner's report, then I would highly recommend that you do. There's some really useful information on there, not least this graph that just shows us the student performance by task. And of course, what we're looking for is to be in the green sections. So the green sections are exceeded and met, and then we go into the pinks, sort of the borderline through to the significantly below and below requirements. So we want to be in those green sections. And yeah, as I said, this evening, we'll focus on task 3, capital allowances. We'll have a look also at task number 5, and then we'll go in and have a look at task 6. Just going to skip through to a little bit of a chat around task 3 before we start to have a look at that one. So task 3 is a human marked question, and it's going to cover capital allowances, but until we get to the assessment, we don't know whether our capital allowance question might be for a company or for a sole trader. And there are some subtle differences between the two, so it's very important that you are aware of those. The time allowed for this task in an assessment is 16 minutes. The time taken is 22 minutes. So that's really very interesting to me that students are actually taking longer than allowed on this task, which presumably means, as we'll see with some of the other tasks, that time is being made up elsewhere. And I can see why this task takes a little bit longer. It is human marked. You are presented with effectively a blank spreadsheet, if you like. So you've got quite a lot of the filling in to do for yourself, the creation of the pro forma, and the filling in of all the individual bits of information. That's going to take you much longer than a task where you're just choosing from drop-down menus. So I can quite see why it takes a bit longer. Only 61% competency on this one, which is a bit of a shame. I do like this area, so hopefully with a bit of help from this session, we can start to push up that competency level. I think there's really some nice marks in here. You've just got to be very careful with your layout. Are they, Catherine? Now that's a nuisance, isn't it? You see, I only get to see what the grid looks like from the sample assessments. We're not allowed to see the live assessment or see what that might be like. But I suppose you've just got to do a good planning. That might be something to note, Catherine, that you actually maybe plan on your scrap paper what you want your answer to look like. We're going to see in the reference material, it does give us a bit of a layout, which might be helpful. And then hopefully you don't have to edit it too much and your answer is sort of your final answer. So you're not trying to move around rows and columns too much as you go along. So some of the weaknesses that have been identified by the examiner in this task are spotting if we have a short or long period and the implications of that. So one of the things that I always suggest when we're doing a capital allowances computation, when you're first reading it and it says, here's the information for the period ended or the year ended, one of the little red flags that you should have waving in your head, is it a 12-month period? And if not, what are the implications of that? So I'm not going to spoil our question by talking about that too much now. We'll talk about that when we get to our question, but that's something to definitely watch out for. Is it a 12-month period? Identifying whether private use adjustments are needed. We'll talk about that too as we have a look at this particular task. But can anybody remember much about this? We could mention this now. If we're dealing with, for example, a partnership or a sole trader business, What are the rules there regarding private use? Does anybody remember? Yes, the private use element is effectively disallowed. So when we come to do our capital allowances computation, if let's say the writing down allowance is £3,000, but that asset is only used half for business purposes, even though we reduce the value of our asset by 3,000, we only claim 1,500 as an actual allowance. So the allowance is basically restricted if there is some private use. We can't claim the full allowance if it's not all for business. Well done. So we only claim the business portion. The other noticeable part is that if we have a sole trader or a partnership, only the owner of the sole trader business or the partners in the partnership trigger any private use. If an employee has private use, that doesn't count in terms of making adjustment in capital allowances. Now, if the employee does have private use of an asset, then that might be something you might have to consider from a personal tax benefit in kind point of view, but it doesn't affect our capital allowances. Another issue that often comes up here is private use for companies. So can a company use an asset? Can our company get in the car and drive it? Can the company make use of the company flat? No, it can't. The company is a separate legal entity. It cannot use assets privately. So again, no private use there. Employee private use, no problem. It's a benefit in kind. It's not anything to do with our capital allowances computation. Identifying the special rate pool rate if we straddle periods. We'll talk about that a little bit more in our task briefing, but the straddling of periods is a little bit less relevant to you under the Finance Act 2020. It was far more relevant last year, and I think that's what the examiner's report is referring to. Allocating car additions into the correct pool. The reference material will help us with this. The task will give us information about the emissions of the car, and that will determine which column in our pool or special rate pool, general pool, or other pool that they may go into. So we've got to look at that carefully. And separately, identifying the AIA, our annual investment allowance, and our first year allowance, making sure we know that they're different things. Something else the examiner mentions is not reading the question carefully. So, I mean, I don't know what to say about that. Read the question carefully. Read the question twice. If the examiner is pointing out that students aren't reading the question carefully, I suggest probably people are just rushing. This is only task 3, so you've got still a lot of the exam to do when you get to this one. Maybe you're still just feeling a little bit stressed, a little bit anxious, and just going a little bit too fast. So do read the question really carefully. So that's what the examiner has to say about task 3. What do our notes have to say about task 3? Let's have a quick look. Well, we've talked already about what sort of thing are going to come up in here. So we're going to see capital allowances. We're going to be calculating capital allowances, including private use adjustments. We have to be familiar with the rules on that. We've just recapped these. No private use for companies. We've talked about that. And then specifically here, companies cannot have a period of more than 12 months for capital allowance purposes. So how am I going to deal with that then? Does anybody remember? What if I have a 15-month accounting period? What if I prepare my accounts from the 1st of January 2019 until the 31st of March 2020? That's a 15-month period. What am I going to do for capital allowance purposes? Yes, well remembered. I'm going to split this into 2 periods. If a company, so many companies, if a company has a period of more than 12 months, we have to split it into 2. We call those chargeable accounting periods or caps. We start with a 12-month one, and then we have the remainder. So another 3 months there, potentially there. So I do 2 quite separate capital allowance computations, one for my first 12 months and one for the last 3 months. And we'll actually practice a task where we're going to be calculating capital allowances for a period that is shorter than 12 months, so we can talk about some of the implications there. So do watch out for short periods. It is one of the things the examiner specifically mentioned that students don't do well with. So watch out for short periods because there are some specific rules. You have to prorata your annual investment allowance. The annual investment allowance, and the reference material talks to us about this anyway, but let me just take the figure from January 19. From January 19, our AIA is 1 million. So we can have expenditure of up to 1 million qualifying for our annual investment allowance. But if my period is only 3 months long, I can't have the full million. I can only have 3 months of that million because that is for a whole year and I'm only looking at a 3-month period. So that only actually allow me qualifying additions of 250,000 in that scenario. We'll have a look at a business closing actually in our example, Shazer. So we're going to see a closing business, so we'll get to that. We also prorata our WDA, our writing down allowance. So rather than having the full allowance, we've got to make sure that we only give them the allowance for the period that we're actually dealing with. So we've got to be really careful with that. Got to be really careful with our rules around cars. That's an important part. And in our reference material, let me just see if I can go there now. Remember, this comes through pop-up windows in your assessment, and there is lots of it. But in the very first pages of the reference material, in the tax tables, there is a section about capital allowances, and in particular, about motor cars. And there it tells us what we do depending on the emissions. So if our car has low emissions, and this is what the government is trying to incentivise, that we buy cars that are electric or with low emissions. So if our emissions are up to 50 grams, we get 100% allowance. So that will be, for a car, we call it an FYA, first year allowance. We get it in the first year that we buy the asset, and it's 100%. If our emissions are between 51 and 110 grams, so medium emissions, I'd call those, then we get a normal writing down allowance in our normal pool. So that just goes straight to our general pool, nothing particularly special about that. Or if our emissions are over 110 grams, which I would call like a high emission, then they go into what we call a special rate pool, a special column for these assets, because they're high emissions. And this was what we were talking about. If the emissions sort of span this April 19 date, we have a different rate before April 19 to the rate after April 19. So you might have to actually prorata those rates to find out what your rate should be. And if you do have to do that, the examiner wants you to round your answer to 2 decimal places. I think it's less likely that that's going to crop up in your exam this year. Last year it would have been very likely because they were dealing with Finance Act 2019, but we're now dealing with 2020. So our year actually starts in 2020. So far less likely to have a question dealing with that. Okay, so I just wanted to point out that was there. Let's go back to our notes. Other things to note, so we've talked about the cars. The additions will either be the 100% one, the writing down allowance at 18%, or the special rate, depending on the emissions. Just also note there is no AIA on cars, so it's either an FYA, normal general pool, or the special rate pool. Watch out for the changes in the AIA and the special rate pool if there are any. That only happens if you have a period that spans January 2019. I'm not too worried about that part. I'm a bit more interested in this. If we have a cessation period, if our business ceases, and that was one of the questions that Shazer asked there, what happens if a business ceases? In the very final period, we don't have any first year allowance, we don't have any AIA, we don't have any writing down allowance, we don't claim anything other than this one-off, we call it like a balancing adjustment. And that balancing adjustment will either be a balancing allowance, where we give the taxpayer a final one-off allowance to make sure that they've had all the credit that they should have, or we have a final one-off balancing charge, where we say, actually, you've had a bit more credit than you should have had. So we want to claw a little bit of that back. So in the final period of trade, it's a final balancing adjustment, an allowance or a charge. Now, there were a few other things I thought we might just revise before we get into this question that we're going to do. So can anybody remind me what happens if we have a disposal of an asset? What do I put in there? Do I include the disposal proceeds? Do I dispose of the cost of the asset? How does that work? Does anybody remember the rule on disposals? Yes. So unless we're looking at something like a private use asset, which is in its own column, chances are we're going to dispose of the items from our general pool. And who was that said that? Anna, yes. So we actually, usually the disposal would be the disposal proceeds. So the general rule is the disposal is in there based on its disposal proceeds, but those proceeds are limited to the cost of the asset. So we can't remove more from the pool than we put in there in the first place. So if the asset cost us £17,000 and we dispose of it for 18, we can't take 18 out of the pool because we didn't put 18 in the first place. So we only dispose of the maximum of the cost. So it's really just the lower of the two figures. Proceeds are lower, use that. If cost is lower, you use that. So watch out for that little rule. Most disposals will be going through our general pool, as we will see. We talked about private use, so we've got to be very aware of that. Does anybody remember the rule about the small pools allowance? So if the balance on our general pool falls to, anybody remember what? Yeah, 1,000, I'm seeing that. So if the balance on the general pool falls to 1,000 or less, what do we do with it? Yes, we claim it all. So if the balance on the general pool becomes 1,000 or less, we can actually claim the full amount in the year. So we do a one-off claim, and it then just puts our pool value down to 0. Very good, well remembered. And then the only other area that I thought we might just quickly revise is the area of short life assets. And of course, this is mentioned in the reference material, so you can look it up there. But if you have an asset where your plan is that this asset will have a life of up to 8 years, yeah, what do? We can effectively what we call depool it. We have to make an election, which just means we have to let Revenue and Customs know that we want to do this. It's not automatic. So we can make an election to depool the asset. And by depuoling the asset, all that means is we put it in its own column. So if its life is quite short, less than 8 years, then at the end of that, rather than it just being in the general pool, along with everything else, it's in its own column. So if I sell it and I have a nice big balance in allowance, I'm able to claim that. And when I teach this topic, I always say that this to me is of less use at the moment, just because of how generous our allowances are already. Remember that we have this annual investment allowance. So when we buy an asset that qualifies, like plant and machinery and that sort of thing, we get 100% allowance anyway. So we don't need this short life asset rule so much at the moment. But you should still be aware of it. It's not really relevant if you're going to be claiming a first year allowance or annual investment allowance on your particular asset, but for anything else, you could use it if its life is going to be less than 8 years. Does anybody know what happens actually if we do keep our asset for more than 8 years though? We put it in its own column because it was going to last less than 8 years. What if it lasts for more than 8? What do we do then? Yes. So after the 8 years, if we've still got it, it just gets transferred into the general pool. Absolutely. But the point of the short life asset pool is just to keep the asset separate so we can claim this balancing allowance when we sell it. But yeah, we don't want to make too much of that little section. It is quite a small section, but just be aware of that. So On to our question then. Just one more thing I'll show you before we get there. We're going to be using our reference material, section 1.1, capital allowances, really important. We're also going to be using section 7. So let me just get to there. And how nice is this? The examiners give us the layout of this task and tell us, see the tax tables for the rates. So they tell us how to lay out the pool. So yes, this is a human marked question. And yes, the grid might be a little bit difficult to edit in the exam, but at least we have the general layout. We don't have to learn this from scratch. This pro forma is given to us and we can use this to actually put our answer together. Not saying it's perfect, it's a guideline. So you can't just type out this exactly as it is and think, oh, that will work. You're going to need a few more rows, but it definitely is a step in the right direction. So as you can see, you have the columns at the top, the first year allowance for our low emission cars, the annual investment allowance for our qualifying plant and machinery, the general pool will be used as well. You might have these special rate pool assets for these cars with the high emissions, the short life asset we've just talked about, and then of course our total allowances are all gathered together in the final column. We'd always generally start with a value brought forward. We would add things on, and I'm going to split my additions into categories. I'm going to have additions that qualify for a first year allowance or an annual investment allowance, and then I'm going to have additions that don't. I would split that into categories. If I've got any disposals, then I need to deal with those as well. The lower of cost and proceeds. If anything has been disposed of from an individual column, like a short life asset column, it triggers some sort of balancing allowance or balancing charge. We've got our allowances that are claimed, the AIA or the FYA. We've got our writing down allowance at 18%. We've got our special rate pool, where we may have to actually calculate the percentage depending on the time period, and then our value to carry forward. Okay, a few little extra notes as well to help you there. So the reference material really is very useful. I really recommend, and I talk about this a lot, but make sure that you know what's there, that you know where to find it. So a few extra little notes on the end. I'm not going to read through all of them. We want to get into our question, but just to say they do go on over to the other page. Make sure you know what you are given, so you're not learning more than you need to. Even tells you about the rule for the small balance on the pool, where the balance is 1,000 or less, then we can elect to write it off. It mentions the short life assets, mentions the FYA, lots and lots of really brilliant information there. Right, the question then, let's get into that without further ado. That's what we're here for, isn't it? Let's have a look at task number 3. So as we begin reading this, let's see some of Anne's little red flags. First thing, Ferguson Limited. That one little word, those 3 little letters tell me I am dealing with a company. And when I'm dealing with a company, a few things spring to mind. I know that I can't have a period that exceeds 12 months. So we've got a maximum of a 12-month period. And I know also that there is going to be no private use adjustments because companies can't use assets. So there's already a few things that spring into my mind when I read the phrase LTD. Now they've actually got a short period. This is an 8-month period to July. So rather than a long period, they actually have a short period. So the period is to July. So let's have a think about that then. 31st of July 20. So it must have started, that's 7 months, isn't it? But it's an 8-month period. So it must have started in December of the previous year. So it must have started in December 19. So that's quite useful to know. Then I've got the tax written down value, and it tells me actually that is at December 19. So I've got my written down values brought forward at that date on the general pool and the special rate pool. So I have a special rate pool then. Remember the special rate pool, as soon as I see that I've got one of those, another little alarm rings in my mind, and I think that's that pool that potentially has more than one percentage. Amy, sorry, you have to download the questions from our Google Drive. If you haven't got them, then you will get a copy of this at the end of the lesson anyway, and then I can send you a link in terms of where to download them, unless anybody has the link handy that can just put in the box for Amy. If you've got the link, I'm not going to stop and do that now. Okay. So in terms of the special rate pool, can I just take you back to the reference material? Okay. And it said, if we're dealing with a period from 1st of April 19 onwards, the rate is 6%. When I look at my timeline, I'm dealing with this period from December 19 onwards. So that is definitely after April. So I'm looking at a special rate pool at 6%. Thank you, Jessica. Appreciate that. And thank you, Amy and Sarah for helping out as well. Thank you. So we've got 6% on the special rate pool. We've got our general rate pool. The general rate pool is always going to be 18%. We know that. It's in the tax tables anyway. Then we have some additions of plant and machinery. Where will plant and machinery go? Are they in, what do you think? Which, if you think about our pro forma, get back to that one now. Sorry, a bit backwards and forwards with this one, but where do you think you're going to put an addition for plant and machinery? Yes, well done, well remembered. In my AIA column. There is a maximum amount for this AIA. We also need to be mindful of that. But plant and machinery, I'm going to say, is an AIA. It qualifies for this annual investment allowance. And who was that said that? Lenka? Yep, the AIA is 1 million. Absolutely right. It's 1 million if I've got a whole year. How long is this period? Is this period a whole year? No, we have to prorata it. So it's 1 million, but I'm dealing with, it was an 8-month period, wasn't it? Oh, I don't know where my calculator is now. Somebody want to tell me what that is? 1 million times 8/12? I found the calculator. Crisis averted. My mental arithmetic isn't quite that good. So 666,667 is the maximum AIA that I could claim for this period. Lovely. So that's another little alarm that rings. Remember, when it's a short period, we've got to be thinking, is there anything we need to restrict here? So I need to restrict the amount of additions that qualify for AIA. And yes, Jessica, the general pool is always 18%. Yes. It's given in your reference material, it will tell you that. There's a delivery van. What about the delivery van? What column will that go into? I'm not going to scroll back to that pro forma, but see if anybody remembers. Yes, you're right, it's an AIA. Because it's a van. If it was a car, it can never have an AIA, but it is a van. So a van can get the AIA. Cars, on the other hand, are going to have an FYA, or go to the general pool, or go to the special rate pool, depending on whether they are low, medium, or high emissions. So our car is 103 grams per kilometre. I have to get my tax tables back out. And 103 grams per kilometre is between 51 and 110. So it's in that category, 51 to 110 grams per kilometre. That must mean it gets 18% general pool. Absolutely right. So 18%, meaning it goes to the general pool. Now they say that there is some private use, and I say, don't try to trick me with that. This is a company. Companies cannot use assets. And it's a sales manager that has the private use anyway. So even if I was dealing with a sole trader, it wouldn't count because only employee private use doesn't count towards private use in the first place. So we ignore that bit. Very good. Reading on, a lot of information to take in here. Due to trading difficulties, the company ceased to trade 28th of February 2021. The sales proceeds were as follows. Look at this, all lower than cost. So when I sell the items, all of them are sold for less than cost. So these are the figures that I'm actually going to dispose of from my general pool, from my special rate pool. The delivery van, well, where was that? The delivery van doesn't have its own column, so that's going to be disposed of out of the general pool. The sales manager's car, it went into the general pool. It's going to be disposed of out of the general pool. Of course, the general pool is the general pool. So we've actually got 3 things in there and only 1 item in our special rate pool. So just reading that through and just thinking really about where each of those will eventually land. So let's check the question then. What does it want? Calculate the capital allowances for the period 31st of July 2020 and the final period to February 21. It is asking me for 2 capital allowance computations, one of them involving a cessation of trade. So a really good question. I can see why people spend a bit longer on this one in terms of timing in the exam, because there is a lot going on, as you've just seen. So we're just going to start putting together then our working. More light on this desk here. We'll start putting together our working for this. And anybody like to tell me? Well, I'll do the first bit for you because we're just going to have our column headings. We've already talked about these. We want an AIA. We want a general pool. We want a special rate pool. And we want our allowances. So I'll fill that in. And I can actually be using the pro forma, to be honest. Given in the assessment, it's going to ask you what comes next. You can use the pro forma. You can do it from memory. After these main headings, what goes on my very first line? Just use the pro forma, or you might remember. It is the written down value brought forward. So you might just see it as WDV brought forward, or you might see it as TWDV brought forward, which would just mean tax written down value. Doesn't matter which one you use, just some sort of brought forward balance really. Then it's a bit of a copy and paste. It told me what my brought forward balances were. I just need to copy them in. So let's just copy those straight in. See the question here, 326,976. And the special rate pool had 78,559. So that's the first thing. The pro forma then tells me I deal with additions next. So I'm happy with that. I can do some additions. Remember what I said about them though. I want to split them into 2 categories. I want my additions that qualify for AIA in one little category, and then my additions that don't in a separate category. So we've already decided, which was quite good of us as we went along, which ones qualified for AIA. I'm not just going to add them all together. I need to show the person marking my work very clearly where my answers came from. So under additions, and I'm just going to abbreviate here. So everything fits in. So plant and machinery, and then a van. That gives enough of an idea. And then I pop both of those into that column for the AIA. Now, what I would do at this stage, perfect world, I've got lots of space, I'd probably even subtotal those. And then I'd say they're the ones that qualify for AIA. So let me just stop there for a minute because I only want to deal with these so far. I've dealt with those 2. The other one's going into my general pool. So let me claim my AIA. It's 100%. So that means all of that is going to be claimed. And it's all going to go to my allowances column. So then there's nothing left to carry forward in that section. There's nothing, say carry forward, we don't carry it forward, we transfer it to the general pool. So any balance that was left over, remember it's restricted to, asterisk there, restricted to 666, 667. I'm nowhere near that, so I can claim the whole amount. Anything that was left over would be transferred to the general pool, but there's nothing. Next, we've got some other additions. Our next addition was this sales manager's car. So I'm going to have another little heading for additions that are not qualifying for AIA. There was only the one item, the sales manager's car. It was 22,700, and we said that we would put it into our general pool. So that one gets added in next. Now, just got to be a bit clever here, because I know that I've got these disposals, but at the moment I'm dealing with, and I perhaps should put this as a heading, I'm dealing with the period to July 2020. Let me include that up there so I know where I am. So this is the period ended July 2020, because I've effectively got two capital allowance computations in one going on here. I think I might have to move that working down, because I'm a bit worried that I'm going to run out of room. Just going to move that down a little bit there, just in case I need a bit more space. Right. So as I read through the question again, during this first period, looking at all these dates, we know that the company ceased trading. We know that they sold these items in that period, but there was nothing about any disposals in the period that I'm dealing with here up to July. So that's it. I've dealt with the additions. I've dealt with the disposals. The next thing that would happen, being as there are no disposals for this period, would be to claim my allowances. So I'd do a little subtotal to see what is the balance on each of these columns. And of course, this one has nothing in it. I want the balance on these next two columns. Please correct me if I make a mistake. So I've got to balance on the general pool and I've got to balance on the special rate pool. Then I want to claim my writing down allowance. Let's do my 18% one on the general pool. So it's always 18%. So it's times 18%. But is there anything else that I might have to do? It's 18%. Anything else? Any other adjustment? Yes. Who gave me that one? Yes, absolutely. Well done. A few people got that one. Thank you, Priscilla, Elspeta. Well done. 18%. But remember my little red flags from the very beginning. Short period. You can't have the whole 18% for the whole year because you're only trading for 8 months. So you time a portion. So you time a portion that allowance. I am writing it here. 41961. So we knock that off the pool and we transfer it over to the allowances column. And then I claim the writing down allowance on my special rate pool. And as we said earlier, does anybody remember what percentage do we get on the special rate pool? Yep, it was 6% because it depended on the date. Turned out this one was 6%, again for 8 months. Was that Lenka or Sarah? You said it gets you every time, yeah? It's one of those little things right at the beginning of the question when you're actually setting yourself up for the question to have as something to think about. So these little red flags you need to be raised. Is it a company? What does that mean for private use? How long is the period? Try to think about it from the very, very outset. Right. So we can subtotal now our two pools. subtotal each of those columns. No, Taryn. The only time that we do that adjustment, which is where we claim the full amount in the pool column, then we restrict it when we take it over to allowances, is where we have private use. That's the only time that would make an adjustment like that. And there is no private use here because it's a company. But I think you're thinking about how we deal with a private use asset. Yes, and I agree with you guys. When you set the question up, you need to be thinking about what the various different things that are going on. And yeah, we could have written that perhaps here. We did underline it, but it is an 8-month period. So it means that you've got to restrict things. So you've got to be very mindful of that. So write it in big letters somewhere on your workings paper. Now, here we have our tax written down value carried forward. And of course, that gets carried forward into the next period. So then I would probably, if I had some room, we are running out of room drastically here, but we've now got another period we need to deal with. So normally I might leave a clear line in between, but there's no room for that. So I'm now just going to have my period ended February 21. That was the end of that one. We'd actually also claim our allowance. Let's find out what our total allowances would be. And just because of space, I'm going to put those on the same row. I usually put them on separate rows, but I'm just short of space. So I'm going to leave them on the same. So let's just add that last column up, because we've actually got to the end of that period. We've claimed the allowances. That period's finished off, and I'm on to my next one. And the written down value carried forward just gets brought down now into this new period, and I start all over again. I've got my balances brought forward. I now have to look at what happened in this last period. Got to think about how long the period is. There were no additions. All we know is that things got sold. So I have some disposals. We did talk about where we would include these. And the disposals are going to be, I'm just going to lump these together. So if they were disposed of out of the general pool, I'm going to add them up and get the one total. And in the assessment, if I did have space in my table, I might do a little explanation of where this figure came from by just putting a working to show I'd added those three things together. So let's just get the figures in to start with. What was the other one? It was a special rate pool, wasn't it? So that was disposed of for 70,000. And this is actually a good question, I think, because it gets to practice two periods. Second period has disposals because it's the end of a period. So it has these balancing allowance and balancing charges to contend with. So this is a really good one. Let's do the special rate pool first. So you tell me what you think this needs to be. We can see it's 5416, the difference between the two, but what is that? A balance in what? Is it a balance in allowance or is it a balance in charge? Any thoughts on that? Remember how this works? Yeah, an allowance, well done. It's a balancing allowance because what this is telling me is according to the taxman's figures, my asset is worth 75,416, but I sold it for just 70. So the person sitting in the tax office thinks, oh, you poor soul, your asset was worth 75,416, you've sold it for 70. You haven't actually had the full allowances on that, have you? You haven't had the full benefit. Let's give you this one-off allowance just to make up the difference. You can have allowance of 5416. Then they look at our general pool and they say, so the assets in your pool were worth 307715. We've seen now that you've disposed of them for more than that. You sold them for more than they were worth. you've effectively made like a profit on sale. So we've given you too many allowances now. We want to get some of those back. So we would claw back a balancing charge. I should have had some brackets there. So on my balancing special rate pool column, 75,416, the 70,000 there as a disposal, another 5,416 knocked off. There's going to be 0 balance to carry forward. I don't think we're really that interested even in the balance carried forward, but we might as well just put it on for reference. It needs to be 0. And here I need my column to add up. So I'm actually going to have this balancing charge, in this case, of 24785, which is like a minus allowance when it comes over to my allowance column. So there's nothing left in the subtotal. That adds up to 0. And I have this overall position here. Again, just for space, put these on the same row. Ideally, I'd have these on 2 separate rows. Just for space, I'm going to put them together. So I've got an allowance netted off with a charge. So my final position is a 19369 charge. So we've actually revised quite a few things through that one task. We've revised a cessation. We've revised the fact that we had a special rate pool. We've revised the AIA being restricted. We've revised the 6% on the special rate pool. How do we deal with disposals? Quite a lot of things going on in that one example. It is human marked, very important you lay out your workings carefully. They are clear and easy to mark. Thank you, Lenka, for helping Nellie out there. Yeah, I think with these human marked ones here, yeah, in terms of roundings, it can go either way. We do tend to, you're quite within your rights to round in favour of the taxpayer. So if that does come out as 3142.36, then you can certainly round to 3143 there, Dinesh, that's not a problem. If you rounded to 3142, that would also be okay. It is human marked and they are going to allow either. Right. So a really useful question there. There's actually another task at the end of this little revision pack. I'm not going to scroll to it now, but right at the very end, there's another short little capital allowance questions. So you are welcome to have a go at that one at some point as well. Taryn, if the disposals are within the period, where do we add them in the computation? Good question. If the disposals are in the period, as in they happened in this main period, then they would go immediately underneath the additions. If we just go back to your reference material, you can see, you can follow the pro forma, brought forward, what were the additions, what were the disposals. So if they were in the period, they'd go immediately under your disposals there. Yeah. So hopefully that answers your question. Great, lovely little question. So I hope that one has been useful. We'll keep going with something else. I don't want to just do one question for the evening. I'd like to achieve a bit more than that. If everybody is still okay for time, we'll just keep going. Our plan was to do task 3 and task 5. And if we had time, we might think about task 6 as well. We'll just see how we go. So yes, keep practicing that. So from your first intuition materials, if you are one of our students, or from materials from your own training provider, go now at some point before I see you again next week and keep going with some task 3 questions. We've had a good little revision of that. I'd like to see you working through some more task 3 questions to get that into focus. We are going to move on to task 5. So let me tell you a little bit about task 5. A short one. 6, oh, that's 4, sorry. Short one as in 9 marks, shorter than what we've just done. 11 minutes, allowed, 7 minutes taken. This one seems quite popular. It takes less time than is allowed and 77% competency. So what do we need to do? We need to, in this task, look at company profits. So we're going to be calculating TTP, remember, total taxable profits, and we're going to be calculating the tax that needs to be paid. We're going to be looking at the allowable and disallowable expenditure from a company's point of view, differentiating between maybe what's capital and what's revenue. Reference material will help us with this. I'm going to turn to that in a moment. Weaknesses involve allocating the income and gains between the two periods. So you told me the maximum is a 12-month period for corporation tax. That's not a problem. A 15-month period becomes a 12-month and a 3-month. But what goes in the 12 and what goes in the 3 months? I don't know why this is a weakness. The reference material tells you what to do. I will show you that in a moment. It's quite clear about how to split income and gains between the two periods. So use the reference material. This one, fair enough, although the reference material also gives you some help for this. Identifying what's allowable and what's disallowable. The main things that people get wrong, legal fees. So the legal fees associated with buying a building, for example, are not an expense. They should be added to the cost of the building. So if they are in our profit statement, we need to add them back. They are not allowable. They're part of the building cost. Knowing that companies don't have private use adjustments for capital allowances, we've just talked through that, and identifying which financial year an accounting period falls into. So they're the weaknesses. This is all just taken from the examiner's report. It's available on the AAT site for you to download and read. It's also available on the FI site if you're an FI student. It's on your course. Right, where are we? Reference material. So I'm going to skip to the section where this is dealt with, just briefly to show you what you get. You get a computation, a pro forma, and it shows you, here's a computation for the year or the period ending whatever. And it says, take your trading income. So imagine you're a painter and decorator. This is your income from your painting and decorating business on an accruals basis. So if you have an 18-month period, we'd time apportion that to 12 18ths in one period and 6 18ths in the other. So it's just prorated, time apportioned, whatever we call it. Interest income. This talks about non-trade loan relationships, also on an accruals basis. What it wants is your interest from non-trade activities. Now, unless you are a bank, you don't have interest received as part of your trade. So this would be things like savings, interest on some sort of bank account. And then from that, you would deduct interest on non-trade loans. So interest paid on non-trade loans. So if you had a trade loan, like a loan to buy a machine, that would be included in here. So any trade interest paid should be within your trading section. Any non-trade loans, a loan to an employee, a loan to buy, oh goodness, an investment property or something that you're going to rent out. Any interest on that sort of thing gets netted off against the interest that you've received, and it gets included as a separate line in the interest line. Property income. So you are renting out a property, you've got some rent from that, net of your property expenses, accruals basis, stick it in on its own line. And then chargeable gains, they don't say accruals basis because they are an actual cash basis. So anything that doesn't say accruals is telling you it's actual, it's cash. When did you get the gain? That's the period it lives in. Knock off qualifying charitable donations, they'd be given in the assessment. We include them based on the actual period the cash was paid. It doesn't say accruals, so then it's actual. That brings us down to total taxable profits, or TTP. And to find the tax that we pay on that profit, we multiply it by corporation tax rate. And for the period that we're doing our exam, that's 19%. So again, just because of how the corporation tax rates have changed over time, you're just going to be using 19% in your assessment because we've had that rate for a couple of years now. That is all given. And it's a little summary of where your income comes from your painting and decorating business. Add on any interest, the interest received minus the interest paid on non-trade items. Add on income from property, add on income from gains, knock off charitable donations, and find your TTP. Okay, so very, very helpful. There is additional information, key points. I'm not going to read through all of this. I want you to do that yourselves at home. But additional information under key points. We're going to practice a little bit of that anyway through our question. It mentions long period of accounts. It tells you how to deal with them. And then it goes on to losses, which come up in a separate section. Right. So, already talked about the sorts of things we're going to be doing in this task. We're going to be adjusting profits for companies. What's deductible and what's not, whether it's revenue, whether it's capital, adjusting our profits and losses, and calculating our TTP, and calculating the tax to actually pay. So all that we've just revised through looking at the reference material and the time apportioning and the cash basis, etc. we've also looked at. Important points. Companies only pay one sort of tax. They pay corporation tax. So we gather all their income together from interest, from gains, from profits, add it all together, and they pay corporation tax on the whole lot. Their period can't be more than 12 months. We know that. If it is, we split it into 2 periods. We've talked about that, maybe like a 12-month and a 3-month. We can't have more than 12 months at once. And if we do have a long period, how do we split things? Well, that's what I just showed you in the reference material. It told you very specifically. Time apportion profits, time apportion interest. The gain depends on when you got the cash. So you follow the rules in the reference material. For a long period, you have 2 capital allowance computations, a 12-month and a 3-month perhaps. And dividends received are not taxable. Dividends paid are not deductible. Dividends just don't appear in our trading profit section, and therefore we don't have to adjust for them. So use the reference material. A lot of what is included in those notes there are included also in your exam. So let's see if we can put this into practice with task 5. Let's see how we go. So Bobsy. Bobsy makes up accounts for the 18-month period. And you know me, I do love a good timeline. So here we go. September 20, 18 months. Well, it's going to be March. All right, March, April, May, June, July, August. Yeah. So from March 19 up to February 20 would be my first 12 months. And I've got March, April, May, June, July, August. Have I counted that right then? No, it's not March, it's April. Good job, I've got fingers, isn't it? Always worth checking. That's better. So April, May, June, July, August and September. So that's my 6 months and then my 12 months for the 18-month period. That's better, Anne. Okay. So I always like my good timeline, so I get that drawn out so I can see what I'm dealing with. The company had made a capital gain in June 2019. It's very interesting. Let me pop it on here. June 19, capital gain, 29,850. On the sale of a piece of land, also made a capital gain on the sale of a building in May 2020. Pop it on my timeline, interested to see where it falls. 11225, sale of a building. And the profits for the period, so the profits for the whole thing, are 760, 500. The whole 18 months. And I just think that having sketched that out on my workings paper, the timeline together with the individual bits of information about the gain and the profits is going to help me when I come to answer this question. So what does it want? State the amount taken into account in each of the following accounting periods. If your answer is 0, enter 0. So the first thing they do, which is a bit sneaky because they don't want to give too much away, is they just say the first period and the second period. Now we know from my timeline, the first period is always 12 months and the second period is always just the rest, but they're not telling me that, they're just saying first and second. So using my timeline, does that now look a little bit easier? What's the gain going to be in the first period? What's the gain going to be in the second? I'm literally going to copy it off that timeline. You are quite right in the chat box there. We literally copy it from the timeline. It's a cash basis. So when did we make the gain? That determines which period it falls into. The profits, not quite so simple because they are an accruals basis. Would anybody like to work out how much profit you'd like to put into each period? Bearing in mind, it has to still come back to this same total. Yes, I can see some workings on there. Thank you very much. And I agree with you. I'm going to put 12/18ths of the whole profit in the first period and 6/18ths of the profit in the second. Thank you for that. And once I've done that, I'm actually just going to check that I haven't lost any profit. In total, it must still be 760,500, which it is. Excellent. Then the next part of the question says, now you've done that, how much tax is payable for the first period? So this is where my pro forma comes in, I suppose, or at least an awareness of what I'm doing, because it's asking how much tax is payable. The pro forma says, gather together all the income. So add up all the income, knock off any donations if you've got any, find what your TTP is, and then times it by 19%. So I now add up my income. I've only got two sources, so it's not going to be too difficult. So if I subtotal those, and I say for the first period, that's my income, and the rate of tax, it's given in the reference material. It's going to be the same for every corporation tax question that you will have in your exam, 19%. I can round in favour of the taxpayer. Again, I think with this sort of question, you'll get marks either way. So you can use normal maths and round up, or you can round in favour of the taxpayer. And for the second period, again, add together the two sources of income. I usually, to be fair, I usually just use normal maths roundings. I don't usually bother with this whole rounding in favour of the taxpayer. So I'll get, yeah, that's right, 52.98 there. Yeah, brilliant. Well done. That wasn't so bad, was it? The timeline is marvellous. You draw it, you split your period, counting with your fingers, because I did have a mistake there on the first go, making sure I've got the right number of months in each period. It makes the gains so much easier. It makes the charitable donations so much easier if we did have any, and the rest is just time apportioned. So well done there. Part B. Now, part B, these true or false questions, we really just have to read these super, super carefully, and you get used to the style of them as well. The more questions you practice, the better you get at these, because some of these true false ones, you might know the topic and still you get the question wrong because you just haven't understood what it meant. So let's see. Taxable total profits are adjusted for all dividends paid. Do you want to give that a true or a false? What do you think? Got a bit of a consensus in the chat box, and you are quite right, it is false. The profits don't have dividends in there, so we don't adjust for the dividends when we're adjusting our total profit, so that's false. And that was actually mentioned, wasn't it, in the task briefing, so we had covered that. A company with an 18-month accounting period. We've got a company with an 18-month period, so that's quite handy. We'll calculate capital allowances for the entire period and then time apportion them between the two periods. Is that how we do capital allowances? No, it isn't. What do? We do two completely separate capital allowance computations. We do one period, we find the balance brought forward, we then do the next period, any additions, any disposals, etc. Two completely separate computations. It's not one computation time apportioned, it is two computations. So that's why that one is false. And then a company with a 9-month period ending January will use the corporation tax applicable for the financial year 2020. This one, I'm going to do a timeline. I really want to explain this to you. So a 9-month period to January 21. So I've got to think about when that period would start. So I've got 1 month already in 2021. So I must have got 8 months in my previous year. So I must have started on the 1st of May, I think. Or June. I think I got my months wrong again. Let's try. I'll count them. Let me say, how many months was it? A 9-month period. Okay. So May, June, July, August, September, October, November, December, and January. So it is May. We've got May 2020 to January 21. That's my accounting period. That's the period I'm actually preparing my accounts for. I now want to compare that with the financial year. And the reference material actually tells us what the financial years are. Financial years start on the 1st of April of every year, and they end on the 31st of March of every year. And this one, because it starts in 2020, is the FY20, financial year 2020. So my financial year, the reference material tells me this, starts in April, ends in March, whereas my accounting period starts on whatever date the question tells me and ends in this case in January. And that, of course, was a 9-month period. So I can see now, in terms of the overlap, does this whole period fall into this whole financial year 2020? And the answer is yes. If my top period there literally just fell into that period on the bottom, it would all live there. So that is true because the whole period overlaps with my financial year. So that was that one. How does that seem? Are we liking task 5? Was that all right? We like task 5, yep. We see perhaps why it's got a slightly higher pass rate than some of the others. Not so bad. Excellent. Better than task 3. It's shorter than task 3 for sure, isn't it? The only thing about task 3 that I really like is that it's human marked. Because task 3 is human marked. You could make a little bit of mistake and the marker could think, but I know what you were doing. I can still give you some credit. With this one, you make a mistake and it's either right or it's wrong. So that's what I'd say about that. Now, I am going to do one more task with you because I don't want us to be too rushed. I want us to have as much opportunity as possible over, we've only got 4 sessions to cover as much of this exam, plus some extra questions if we can at the end. So if you do need to go, I appreciate that. It's 22. We won't go more than 20 minutes on this next task. You'll get a recording, so if you can't stay, then don't worry, but we are going to do one more task. We're going to do task 6. So let me just tell you about task 6. Task 6 is a short one, 7 marks, 8 minutes, takes 6 minutes, 69% competency. So it's not bad, but it could be better. What's it about? It's about the filing date and the payment date for tax returns and tax payments. So we're going to be looking at partnerships, we could look at sole traders, we could look at companies, finding out how much tax is due on each payment date. In terms of weaknesses, getting the years right. This is where Anne's timelines come into their own again. You'll see I'll be on timeline overdrive again with this section. So timelines, getting the years right, really important. Making sure you've got the right amount of tax due on the right dates, and particularly for individuals, which we're going to have a look at now, when payments on account need to be paid. So I really like this task. I think this is a great little task, but not everybody agrees. But yeah, finding deadlines, payment rules for sole traders and partnerships, as well as for companies. Another great thing is this wonderful reference material, which tells us all this. To be honest, it's all there. Section, find it here, 10. Section 10 in the reference material is headed up Payment and Administration, Sole Traders and Partners. So it tells you the dates for filing of tax returns. It tells you the dates for making payments as well. So maybe specifically 10.1 and 10.4 deal with that section. And then for companies, separate section for companies, they are in section 16.1. Got a whole section for those as well. There is reference material to help you, make sure you know where to find it, make sure you know what you are doing. So I think just because of time, we're not going to review all the rules. We'll actually review the rules as we work through the question for this one, rather than reviewing them and then going on to the question. So we will still be looking through the rules, but just in the context of the question. Okay, so do familiarise yourself, please, with all that reference material. There's a little section there to tell you where to look. Let's have a look at what it's asking us. Lauren is one of your clients. She has several Italian restaurants, and over the past few years, you have agreed her tax liabilities as. And this is, I think, sometimes where we panic. We've got 4 different tax years given. And it's like, oh my goodness, I feel a bit overwhelmed with numbers. In order for her to budget, Lauren has asked you to remind her of any tax payments due in 2020. Respond to Lauren explaining the amount and date of each payment that she needs to make for the calendar year of 2020. Right, what am I going to start with? Well, you can guess what I'm going to start with. I'm going to start with a lovely timeline. Lauren's asking me what she needs to pay in the year 2020. Now, I've got these different tax years and I don't really know which one I'm going to be dealing with at this point. So let me just choose one that maybe has 2020 in it, and let me draw 2019-20. Just because it has 2020 in it, it seems like a good place to start. This tax year runs from 6th of April of 19 to 5th of April of 20. Can anybody tell me, when is the first payment of on account due within any given tax year? So here's my tax year. When is the first payment of account paid within that tax year? It's in the reference material, so if you can't remember, it doesn't matter, but you can remember. I thought some of you might. Well done. It is the 31st of January. So 31st of January 2020, you would make a payment on account. How much is that payment on account? Does anybody remember that? You make 2 payments on account, don't you? So that's a bit of a hint. It's 50%. Yes, thank you. It is 50% of what though? So it's the first payment on account, and you're quite right, it is half, but half of what? It's half of the previous tax bill. Well done. Half of the previous tax bill. So my previous one would have been 2018-19, 29,200. So it would be half of that. When is my second payment on account? It's 6 months later. It's the 31st of July of 2020. What do I pay then? I pay my second payment on account, which is another half of the 29,200. Because my payments on account are based on last year's tax bill. So when would I pay the balance of this one then? When would I actually pay the balance of my 2019-20 tax liability? It would be 6 months later. It would be the January of the following year. So I would pay the balance then. So that's the balance of the 2019-20 year. Now, Lauren asked me about the payments made in the calendar year 2020. So definitely this one and definitely this one. But have I missed anything? Can anybody spot what I haven't done yet? And I just did that last bit on the end to try to prompt you. There would be the balance of the previous year, wouldn't there? So what about our previous tax year? Our previous tax year would have been 2018-19. And in there would have paid our first payment on account, January 19. July 19 would have paid our second payment on account. And then in January 20, we would pay the balance. So the balance of the 2018-19 tax would need to be paid on the 31st of January 20. So my timeline, I think, is super helpful for that. And I'm going to now work out in my answer to Lauren how much is going to be paid when. So respond to Lauren explaining. Look at that word explaining. So making sure I'm clear about the amount and the date of each payment she needs to make. Let's start with the balance of 18-19 then. So let's start with, and I'm just going to do some rough workings here. I'm not going to put a whole answer together, but let's just say payment due 31st of January 2020. That can be my heading. And then let's just say it would be the balance of the 2018-19 tax liability. And how much would that balance be? How much would she still owe where she has to pay this balancing figure here? How much would that be? Any thoughts on how I'd calculate that? Think about what the 2019 liability is. She's supposed to pay 29,200. So the total due is 29,200. What's she already paid? Well, she's paid payments on account based on the previous year's liability. So the paid on account is 24,500. So the amount now due to be paid is going to be, we've already got this in the chat box, faster than me, 4,700. So 29,200 is due. She's paid 24,500 on account. 47 is now due. And that's the balance of the 2018-19 liability. Then we said there would be the first instalment of the 2019-20 tax liability. And we said that was going to be 29,200 divided by 2. So 14,600. So the total pay, or total due rather, if it's a budget, total due for January 20 is 19,300. And I've run out of room again. I think my writing's just too big. It did say explain, so I'd have to add a few more words in around this, but you get the general idea. I would want to say the first instalment of 2019-20 is based on my 18-19 liability. So if I was explaining, I wouldn't just say take 29,200 divided by 2. I'd say take that liability. Okay, nearly there. I would just finish off, although I've run out of room. See if we can just add it into the bottom here. My payment due in July 20 would be the second payment on account. If I've explained it already in the first part of the question, it doesn't need a huge explanation again. I just need to say it's that 14,600. So I do think the reference material can help you with that if you're a bit muddled with the dates. As I said, I would start with a timeline. I'd make it very clear on my timeline, what is the period for the tax year? I'd make a little note of first, second and balance, and then I'd say, okay, where does 2020 calendar year fit with that? If she's budgeting for the 2020 calendar year, how does that fit together with what I've got on my timeline? That's exactly what I did, and that's how I got this answer together. Now, the nice thing about this question in terms of a revision is that that was Lauren. Lauren is an individual, as in a sole trader, and then we've got the sole trader rules. We then go on to part B, where we move into companies. So we've got sole trader and company within the same question, so we get to revise both. How great is that? So Perea Limited has a set of accounts for 18 months to June 2021. And we have these two chargeable accounting periods. Very nice of them to tell us this. We already know that these are 12 months and then 6 months. We can't have longer than 12 months. So an 18-month period altogether. So the first 12 months and then the rest. We know about that. So that's the profit made in each. Complete the table to show the latest date for the payment of tax and the filing of the tax returns. The wonderful reference material will help us with this. So 16.1, payment dates. Small companies with profits of less than 1.5 million. What are the profits here? Definitely less than 1.5 million, will pay 9 months and 1 day after the end of the accounting period. So 9 months and 1 day after the end of the accounting period. So in terms of the payment date then, we could actually even have a timeline if you wanted. I'm not sure it's exactly necessary here, but just because I like them, I'm going to draw one anyway. So we've got our period to December, that's our first chargeable accounting period. And then we've got our next period ending June 21. So for each of those, you are going to add 9 months and 1 day. So the tax for my first chargeable accounting period, 9 months and 1 day after December, and then the next one, 9 months and a day after the June year end. Or the June period end. So starting with the December one then, 9 months will take me to where? And an extra day will take me to where? What do you want to put in there? My tax due date, yes. I'd do the 9 months first to take me to the end of September, then I'd add a day to take me to the 1st of October, 21. Oh, look at that. Didn't really follow the question instructions there. Do watch out for that. If it gives you a specific format, please use it. So it says 1 October 2021. Then the next one, my period ended in June. What's going to be 9 months after that? Well, 6 months will get me to December. Another 3 months will get me to March. So April then, isn't it? That extra day takes me to the 1st of April of 2022. Fabulous. So that's the payment date. On my desk here for this reference material. So it started off, the reference material started by talking about payment dates, and it goes on to look at the filing of the return in section 16.3. So it's all there for you. So we've looked at payment dates. Let's get to filing of the return. Filed on the later of 12 months after the end of the accounting period, or 3 months after the notice to deliver a tax return. Okay. Now this one's a little bit different, because when we do this one, we only actually file one return. So we're going to have a filing date which is the same for both. And we're going to say the end of our period was June 2021. So we're going to file this a year after that. So June 22 for both. Seem to be very good at these formats, do I? Silly me. So yeah, really interesting distinction there in terms of our payment dates, because the payment dates are 9 months and 1 day after each individual period, but our CT 600 is just the 12 months after the end of the final period end date. So do watch out for that. That's one that often trips us up. So both in 2022. So Jessica, yes, absolutely. And I think that's it for that task. Yeah, so that's 3 tasks completed at this evening as well. So it did take us an hour and a half, but I'm not too worried about that. So I think we can deal with any questions that you've got. I'll probably stop the recording now and just say thank you for attending the session. I'll stop the recording and then I'll deal with any individual questions that you might have and maybe talk about what we're going to do in the next one.